invest in an index fund,
not financial advice, etc., it's pretty reasonable to put that money in a stock market index fund like the S&P 500.
And just invest consistently and automatically using dollar cost averaging.
Dollar cost average, where you invest a fixed amount of money at regular intervals over a certain period of time.
So for those of you who have been hanging out on the finance side of YouTube, you probably have came across an investing guide or two, ranging from short form content between 10 to 15 minutes to even long form ones up to an hour, explaining to you what is the stock market, why is investing important, what is inflation, and why must you invest for your retirement. Essentially, I think I can boil down most of these videos into two key points that are actionable. Firstly, it's to choose a low-cost index fund that is broad-based enough, and most of them usually cite the S&P 500. And secondly, you probably want to devise a strategy that is applicable in your life and to engage into something called dollar cost averaging. So in short, dollar cost averaging requires you to pick a fixed amount and a fixed interval, hopefully assuming that you have a long enough time horizon to ride out the market volatility. And hopefully within the next 15, 20, 25 years, the compounding will work its magic and you will have a pot of gold waiting for you. So I think most of these discussion points and suggestions or even recommendations are rather healthy. And in fact, it's the golden standard of the finance industry today. However, in this video, I would just like to provide my thoughts on what most investing guides don't tell you. And more importantly, to add some nuance to this entire discussion. So rather than saying that I'm criticizing the strategy, I'm more inclined to believe that I'm trying to temper the expectations of most viewers here that are really at the beginner level. I'm trying to understand this entire shenanigans around investing, finance, retirement, risk reward, returns, etc. I came across this chart 2 weeks ago and I stopped in my tracks. And my first thought, whoa. My second thought, is that actually right? So the chart is attempting to illustrate how the stock market has experienced multi-decade periods of zero return over its history. So you can see, based on the title of the graph, it's the real S&P 500 index periods of zero returns. So real returns means that it's inflation adjusted. In the earlier part of the index, there was a 52-year period of zero returns. And of course, the most recent one, which was impacted by two main crises. Firstly, it's the dot-com bubble in 2000, and more importantly, the 2008 Great Financial Crisis. But to add more color to this entire discussion, the chart above is actually a mix of both lies and truth. So it's true that there have been multi-decade periods of zero growth, but the lie is this chart actually do not include dividends. So the y-axis is a log function, and this is the normal way of showing long-term investment return data. There are 4 distinct periods that the S&P 500 have underwent lost 1 or 2 decades. So these are the 4 different periods ranging from 14 years all the way to more than 20 years, which is why the conventional wisdom is hopefully you have a long enough time horizon to weather out this volatility and to continuously buy as the stock market do its own thing due to the auction nature of the entire market itself. So here's the key issue that I have with most investing guides on YouTube today. So I believe most of them actually started out with very good intentions in trying to spread the idea of investing for retirement to the masses. However, I think the biggest worry that I personally have is really the idea between expectations versus reality. So Webull has decided to start your new year right with amazing new sign-up rewards. So for new users to Webull, you can now sign up, subscribe to minimally $500 in Moneybull, and maintain it for 30 days to get 25 free shares worth between $3 to $500 each. So you can further enhance your New Year rewards by participating in the Moneybull campaign, and you can potentially enjoy up to $3,000 worth of cash vouchers if you actually hit and qualify the highest tier. So personally, as I've participated in the previous Moneybull campaign, I've already received my cash voucher as seen in the screenshot here. So what are you waiting for? Do make sure that you comply to all the requirements of the campaign, and I'll see you guys on the other side. So grab your rewards today with my link below, and thank you Webull for sponsoring this video. So I believe that many of them in their video have put out explicit disclaimer telling most people that, hey, investing, it's going to be a very, very volatile game. You're not going to get your 8 to 10% expected returns smoothly over the next 10, 20, 30 years, however long your time horizon is. In fact, you can see that just the last 5 years alone, the S&P 500 is all over the place because we have experienced two bear markets, once in 2020 and another time in 2022. More importantly, I think most beginners are also not ready to see their positions still remaining underwater even after 5, 8, 10, 15, 20 years. And we have seen the long-term investment return of the S&P 500 real performance over the last 150 years. If to add all of them up, out of 150, around 70 years were in the lost decade period. And of course, hindsight is 2020. Many people who have invested much earlier on would be a lot richer today. But the issue comes in two-pronged. Firstly, you have to have the tenacity to continue holding on to your position despite not seeing returns over a long period of time. And secondly, your ability and your fortitude to continue buying into an investment vehicle like the S&P 500. Even though it's not producing the expected results based on many of these guidelines of around 7, 8 to 10% returns over a long period of time. So let me give you an example of a time period. And I extracted the performance returns of the SPY, which is the S&P 500 equivalent, between the time period of 1999 until today. Want to take a guess how much the SPY has returned over the last 24 years or so? It's actually 273%. However, if you actually start from 1993 instead, which is 7 years earlier, you would have experienced a 984% gain. And I believe most of you would agree that it's a huge difference, and in fact, it's a very, very huge delta. And one key factor that investors underappreciate the most is actually the element of luck. And if we use a simple S&P 500 historical returns calculator from January of 1999 to December of 2023 with an initial investment of $100, the nominal price return is actually only 275%. And that gives you an annualized return of 5.45%. If you have dividends reinvested, that's 488.98%, and that's an annualized return of 7.38%. So at least from the SPY ETF, this is purely just from capital returns, and we ignore the dividend returns. Another important factor that you probably want to consider is also the real rate of return, which is inflation adjusted. So on an annualized basis, it's actually only 2.85%. With dividends reinvested, it's actually 4.73%. It's a lot lower compared to the 7, 8, 10% returns that most people have been touting about the S&P 500. But of course, you might say that, hey, aren't you just trying to cherry pick the data? And it's completely true. I am cherry picking the data. And the biggest worry for most investors today is really the question of, what if I'm the unlucky one? And especially so for those of you who actually started investing much later in your 30s or in your 40s. Think about it. At 40 years old, you start dollar cost averaging into S&P 500. And after 24 years, that's right around the time that you're going to retire. At around 65, the promised elusive 8 to 10% return didn't come into fruition. And in fact, your nominal total return actually only came in 5.45%. Assuming that you didn't reinvest the dividends. So I think those are just some of the nuance to this entire discussion that I wish to provide some color on. And for those of you who actually thought that I tried to cherry pick the data and why did I start at 1999, it really wasn't on purpose, because I was actually researching about the index of the Indian market, and the Nifty 50 is probably one that is comprehensive or the most mainstream one. And I mean, based on Google Finance, they gave me data starting from 1st of January 1999. The Nifty 50 actually returned around 2,300% compared to the measly nominal price return of the S&P 500 in that same period of 275%. Actually, it means that the India index, if you have invested early enough, they nearly 10x the return of the S&P 500. That's a pretty interesting observation, isn't it? So some of you might actually bounce back and ask me, hey, what if I actually dollar cost average in the lost decade period? Over a long enough time frame of at least 20 years, I'm supposed to come out positive, right? Here's the chart that actually explains it all. So you can see that there's three colored lines here. The green one is a 20-year period, the pinkish one is a 30-year period, and the blue line is the 40-year period. And similarly, this is inflation adjusted, which is a real rate of return with dividends reinvested. And let's just ignore the pink and the blue one. Let's look at the 20-year period. Think about it, a 20-year period, which is what most of them are promising you that you are going to get a sizable amount of nest egg for retirement. You can see there are times where you still go under 0%, meaning you have a negative real rate of return after investing dollar cost averaging into the S&P 500 for 20 years straight. You are still having a negative real rate of return. And that's essentially the scary part. That is also why, on the flip side, this is really a lot about managing psychology and managing most investors' expectations. You probably want to go in with the expectation of the worst case scenario. And in this case, at least over a 20-year time period, you can observe that there is still a negative return profile. And really, this downside scenario of having a negative real rate of return is only eliminated after having a 30 or even a 40-year time horizon. The issue here is not many people have that kind of time horizon purely from a longevity perspective. So here's the main takeaway from this video. Know what you are getting yourself into. Please don't have very lofty and idealistic expectations of the investment returns of the S&P 500, thinking that after 20 years, I'm definitely set for retirement. And number two, when we look at the data, you know it's extremely important for compounding to take place. So please have your dividends reinvested. You can easily do so by buying into ETFs or mutual funds that have the accumulative function, rather than allow for the ETF to give out a quarterly or a yearly dividend, and then you think that you can get away by spending out the dividends. The annualized return over a long enough time period actually comes out to a substantial number. So please allow compounding to take place. And point number three, please do your homework before you put your money into anything. And I hope that I provided a little bit more color in this finance space, and I'll see you guys in the next video. Goodbye.